We're going to be talking about a rotational trading day today. About 85% of the days have some rotation involved in them. So it really is extremely important. Some of the things we're going to show you today aren't normally things you would associate with a foundational course. However, because of the complexity of trading and because there's no practice field, anytime you trade, you are live competing with the best traders in the world. So it's important that we not sugarcoat a foundational course and give you a false sense that it's easy. Today, we're coming off of what is called a short covering day from yesterday. Short covering days are very often noted by what we call the P formation. If you notice the A period low, which starts the stem of the P. And if you think about the P, you've got a stem and you watch the stem go all the way up and you finally get the loop of the P. So we've got the stem in the loop, which is the short covering day. One of the things that's characteristic of a short covering day is it generally weakens the market. And it weakens the market because it has taken the buy orders. The way you cover a short is by buying. When all the shorts, not all the shorts covered, but when a substantial number of shorts have covered, that potential buying power underneath the market is no longer there. Now, the logical question to say is, well, how do you know it's short covering? How do you know when a market goes up like yesterday, it wasn't, more serious money in buying? Well, I know from experience, and I know that if in fact we had a combination of old business is short covering because when you cover a short, you already have a position on. And what you're doing is coming out of that short or out of that position. So the only way you can get out of that is through buying. So we call that old business. If you had a combination of old business, which is the short covering, and new business, which was new money coming into the market, the chances are that the profile is going to be far more elongated because you have a more consistent buying pattern and you have people with longer term objectives. Traders that are covering shorts, they have a very short term objective. Just get me out of this position now. Longer term buying coming to the market, they don't have that same short term orientation. They want out of the market, or they want in the market, and they want to be able to hold those positions, often for some measurable period of time. So when I see a P formation, short covering, more than likely it is only old business. And as said, once the shorts are out of there, that can weaken a market. Now you have something else going. When you have a short covering market like this, the momentum traders are still going to be thinking the market's fairly strong because they have a tendency to follow price. They don't do a lot of thinking. They just follow price and go with price momentum. Now, the next thing we notice on yesterday's high, or on the high from the 11th, is that we had a non-excess high, meaning there was no single prints on the high. It takes two single prints in order to have an excess high. You go back to the next high that's up in the same area as yesterday's high, and that high is from 9.6. That was also a non-excess high. So we have two out of the last 4 days non-excess highs. So when I see that, I'm surprised it didn't take it out yesterday, but the odds are greater now that it will be exceeded or taken out today. So that's something that we have to keep in mind. Now, overnight trade, which is on the far right, the overnight trade did take out yesterday's high as well as the high from 9.6. However, there was no substantial upside follow through. Overnight inventory is fairly balanced. We measure overnight inventory from the settle, and the settle on the 11th was one tick below the round circle. So you see the round circle there, and one tick below that is the settle from yesterday. And so when we look at the overnight trade, we look to see the amount of trade that took place above and below the previous day's settle. And that will tell us, you know, some idea of how long or short overnight trade is. There's no meaningful difference in the overnight trade from the night of the 11th. Maybe a little more long than short, but overall it's balanced and it wasn't a very wide range. The circle near the bottom of the overnight trade, the green circle near the bottom of the overnight trade, is where the market is trading just prior to the market getting ready to open in the morning. Jen, if you can point out the last trade down on the lower end, that circle is where the trade was taking place in the electronic market just prior to opening in the daytime frame market in the US. So what do we know from that? When we see where that's going to take place, we know we're going to open within the previous day's range. When we open within the previous day's range, the odds increase that we're going to have an inside rotational day. In other words, when we trade within the range for the previous day, the market is not out of balance relative to that day. The biggest opportunities come when the market trades out of balance relative to the previous day, or trades out of balance and comes back in. But generally, when we're going to open within the previous day's range, the first thing that goes into our mind is that we're going to have a rotational day because there is no substantive difference relative to the previous day. So with those thoughts in mind, let's get ready to replay the trade of 9/12. And we'll take a look at what we've talked about and see if it really tells us anything, if that idea of a rotational day is meaningful or not. So remember, when we open, unless the market trades out of range from the previous day, we're probably going to stay rotational. Okay, so the market's open. We're playing this at 3 times the normal speed. When the market opens, we open within the range of the previous session. We immediately trade down to the overnight low. Very common. It's a very visual reference. Traders have a tendency to take markets to very visual references. You'll see that the market rotated back up a little bit, about the same place where we opened this morning. So early on, it's a pretty quiet market. We're not getting much information to go with right in here. Now, the next thing we're going to be looking at is the unchanged level. The green circle from the 11th, one tick below that is the unchanged level from yesterday. And the unchanged level is always a traditional, important, short-term trading reference. Most of these traders are sitting in front of machines. If we are below the unchanged level, their machines are red. If we're above it, their machines are green. It may sound silly, but that's the level of, thinking that a lot of these traders put into the market. So right now, we traded, I believe we were traded one tick short of unchanged. So if we can stop here for just a second. When we trade one tick short of unchanged, and sell off, then I know that that is a weak reference. Anytime a market goes to within a single tick, either added a single tick above or below, that's being a little exacting, but that tells me a lot of information. That tells me that the traders that I'm competing with right now are of the shortest time frame. The significance of that is the traders of the shortest time frame are the traders that are more likely to change their positions very quickly. Now, it's not necessarily from a thoughtful standpoint. They can panic in and out of positions and give the market volatility. Okay, so first we traded, I believe it was a tick short of unchanged. Then the market went back and traded exactly at unchanged. So that the odds are very low right now that the morning high that you see right now is going to last for very long, as well as the low is exactly at the overnight low. So the chances are really good before takes much more of the day transpires, we will trade back and forth through those two references. Does it have to happen? Of course not. But I'm just saying the odds are there. These are the things, these are the observations that are important for you to see early in the morning. You want to make it more of an automatic function. This is what we call chunking. Chunking is the same thing that allows you to back a car out of the garage. First time you back out, it's very slow. The more you do it, the more it becomes second nature. The more you trade, the more it becomes second nature to see that the low is exactly at the overnight low, to see that the early morning high right here is at the unchanged level. Those are important references. Neither one of those references are usually strong enough to contain the market. All right, let's continue to let the market run. I just see back and forth. Okay, we said the odds were good that we would come back and take that low out. That still leaves us with the early morning high, which is, at an exacting level. So now we see what happens there. See, if you know these things, sometimes you'll miss a trade, but you really reduce the odds that you get caught in an emotional state and you start, being very emotional about getting long. Oh my God, I got to cover. Getting short, I got to cover. A much better calmness and understanding what the market's doing will help calm your nerves. It will give you a much better perspective and ability to identify and enter into opportunities when they exist. So now you're seeing the market is almost back to the unchanged level. So again, we're replaying this at 3 times speed. So you've seen a tremendous amount of information, very helpful information here this morning. Some people, they just say, oh, well, I don't see anything. It's there. This is the information that you have to capture, and you have to be live with the market. You have to be involved with the market. You're not playing with the kids. You're not on the phone. You're not telling jokes back and forth. You're involved with this market, at least at this point. Okay, so we're back. We said we'd probably be back to that high, which we were. We've seen both the high and the low taken out, but the high is still no good because now I think it's only a tick above unchanged. So it's still not a good high. One of the things we record at this point in time, how much confidence does this market have? The confidence level is very low. We're within the previous day's range. We've been back and forth through the overnight low. We've been back and forth. Now we're back just above the unchanged level from yesterday. So, okay, we're a tick above it. Now we watch and see, what happens here. I still say the odds are pretty low that the high is in for the day, because we're one tick above unchanged level from the 11th. So very low odds, in my opinion, that that high is in. Okay, now we've taken it out by 2 ticks. So it's possible it's in now. You know, you need at least 2 ticks to do it. So very important that you see what we're talking about today. Now, I've got a little bit of a bias on this day, and because I thought the market from the previous day was relatively weak, even though it made a great price run, I thought the day was relatively weak. Okay, now if we can stop here for a second. I'm going to share a trade with you. And it's not what I like to do, but it helps you understand what I'm talking about a little bit. Early on, we said that it didn't appear that either the high or the low, the early morning high or low, were going to remain, because the first low was exactly at the overnight low. The second high was a tick below unchanged level. When the market traded back up to unchanged, and then it traded back down through the overnight low, at that point, I bought some calls. I go long calls. It's just delta long. But it doesn't make any difference whether you get long through calls, which just puts you delta long, or long through futures. It's just a different way to evidence your belief in the market. Now, what I'm going to show you here is a little more complicated, because being long the calls, a call is the right to buy. It also allows me, if I want, to go short against those calls, and I have a protected position because the call gives me the right to buy. I know that's complicated, and particularly for a foundational course, but markets are complicated. I'm going to introduce it to you now. If you want to understand more about options, you're going to need to do some study on your own. We have several sessions. If you enroll in one of our intensive courses, we have several sections on options. But I'm just introducing it here now because I'm going to show you the way I played this market. Again, it's not easy. I'm sorry if I confused some of you, but it's a way to evidence my belief. So the market left a poor high or weak high because it was a single tick below unchanged. It went back down, took out the overnight low, which we thought it would. When it did that, I bought calls. And when I buy calls, that's meaning I think there's a possibility or probability that the market will rally. When the market rallies, I have options. I can just sell the calls, take my profit. I can go short futures against those calls. I have alternatives. Okay, so let's play this out a little bit more. So right up here, when the market takes out the early morning high and trades above it, I go short 50% futures against my calls. So for every 2 calls, I'm short 1 future. Remember, the call is the right to buy. If I'm short the future, the right to buy gives me the ability to cover that future if I need to. So now the market is trading off. As prices go lower, I'm making money on the futures, on the short futures, and I'm losing money on the calls. So the market's, it's just kind of back and forth, relatively narrow range in here. But we have cleared up both the high and the low. Things may change, but at least so far. Okay, Jen, let's speed the market up. We're at 3 times. Let's go to 10 times. Okay, so we're speeding up. You see, we're still within the previous day's range. Being within the previous day's range suggests that it's going to be a rotational trading day. So far, we've had rotation. It's been relatively mild rotation, but there is some rotation. The market's now back down near the overnight low. You see the green dot is the opening, so it's back and forth through the opening. So there's not, there's no real conviction in here. One of the things on a rotational trading day, when we open within the range for the previous session, I suggest that traders not trade early, because they trade early, they get involved and they get caught in the chop. Okay, now I did trades for a reason, because I had 2 references. Okay, so we're still within, we've now gone to the second half hour. Market went back down exactly to the overnight low. If you look at the B period low, it's exactly at the overnight low. So that is a very mechanical pullback low in B period, not particularly representative of a lot of strength. Again, why? Because some trader had to have an exact place before he would come in and buy that market. Okay, so still rotational, relatively narrow base. When you have a narrow base like this, the chances are good that you're going to have a trend day, or at least get a wide expansion of that base. If you just go back and review many trading days, it's rare that you see a range that is that mild. Okay, so now the market is starting to extend on the downside. So we extend on the downside. One of the things we're going to be looking at is we're going to be looking at the half back level from the previous session, which is at 2880.25. That doesn't mean it's going to get there. It is just a level that traders tend to follow. Short-term traders. Longer-term traders, they probably have no idea what that is. But short-term traders, which are their own breed, they have half back, they have the opening, they have the overnight high and low, they have unchanged. Those are the references of the short-term traders. So this market is trading lower, it's pushing lower. Remember, we're trading at 10 times the speed. Now, some of the things I'm talking about here, for those that are involved in the intensive, we have what was called a live chat. And the live chat talks about the comments that we see in the market. And from time to time, I may reference something that I have done. So as this market's going down, it's a post or a comment I make a little later on, getting real close here. And what I said was, I was short, and I said, I covered my short futures, right around the half back level. Now, I don't wait for it to go through half back. I cover usually a couple ticks short of it. And why? Because I think there's a pretty good chance that that's where the market's going to go. And one of the things I don't want to do, I don't want to be an exact. If you try and be an exact type of person, you're going to frustrate yourself an awful lot. And it's easy to miss things. So I'm not an exact trader. So this market, I had my goal and I said, okay, I'm going to cover this short, someplace around the half back level. So before it got to half back, I covered it. Notice that the market went down and stopped. You got a little bit of hesitation right around half back. Okay, now we take it through. Remember, and if we can stop for a second, remember, this is an inside day. An inside day simply means it's a day that takes place within the range of the previous session. Now, sometimes you'll maybe look a few ticks above or below, and that really doesn't disqualify it as a rotational trading day. But rotational trading days are just that. You're looking for a rotation. If you're making trades, you're more than likely going to look for shorter term trades. Less profit. You're going to be in those trades for shorter periods of time because more than likely they're rotational. There will more than likely be more opportunities on a rotational trading day, but those opportunities will be less. So you should be a little bit faster in most cases to take your profit if you have one, because again, you're not trying to hit a home run. All right, so at this point in time, let's review my position. For every 2 calls, I was short 50% futures. I got about, I believe it was, let's see, a 91. I think I ended up with about 8.7 or 8 points of profit on the short from the 150 or the 50% futures contract. Now, the calls were a little bit over 5 handles apiece. So at this point in time, the calls are almost paid for. So, but now I've covered the short future. I'm now back to 2 long calls, or if you take on a 50-50 basis. Okay, let's continue to play. Half back was my goal. It exceeded my goal slightly. Like I say, I covered before we got there. And now I'm just sitting with the calls or delta long position, expecting rotation. See, we talked about how short-term traders look so much at very mechanical levels, half back, overnight low, overnight high, the opening unchanged. Those are the worlds, that's the world of short-term traders. Those are the references of the short-term traders. That's what they live and die on, looking at those references. Now, we have a double distribution right now. If there's anything meaningful in this market, we will go up and we will cover. Well, I we won't cover that double distribution if there's anything meaningful in the market. We'll leave a double distribution day to the downside. So the market has left the double distribution.
And just to review what double distribution is, you can see here on the profile where the 3 single B prints, that's what's keeping this a double distribution at this point in time.
So it's 2 separate distributions. Closing that distribution, and to close the distribution, you would have to print at the AB price level. You'd have to go 3 ticks wide up there. So the market is keeping the distribution. Remember, my position right here is just long the calls, which is delta long. So you see we are rotational. We're within the previous day's range. Rotational days, the market deals with a lot of indecision. Some people are buying, some people are selling. A lot of short-term traders lose a lot of money on these days because they can't they get long, they get short, they get long, they get short, they get whipsawed. Okay, so now I want you to watch this very closely. Okay, now if you can stop here for a second. D period took out C period. Notice the D period high is a single tick below the AB, and it's a single tick below covering or closing the double distribution. Another way to think about it is if it trades up there in what was earlier the upper distribution, you're fusing the initial lower and upper distributions together. So it's more of a shot that you're going to have a rotational trading day, even more so. Now, we use the term a lot of times, letting the trade come to you. Early in the morning, I let the trade come to me when we saw the market trade, around one tick from the settle from the previous day. When the market broke, I bought the calls. That was letting the trade come to me because I saw something in the market. When I then got an opposite reaction, I thought there's a good chance we're going back there. You're going to see another example of it right here. D period printed a single tick below the AB low. Now, what I'm going to do, remember, I'm already long calls, but when the market trades lower, I'm going to add to my call position. In other words, I'm going to increase my delta long position, thinking that the odds of a rotation back up towards the high by filling that second distribution have increased substantially. So when that market broke down there below without filling that, I added to my call position. Okay, let's continue to play. So you see the market one more time, stopped one tick short of trading into that, what was the initial upper distribution. So mechanical, when they sell it exactly at a reference like that, that does not give you good odds for downside continuation. Does it happen sometimes? Of course it does. It's just that the odds aren't very good. Okay, so at this time I have my original calls from the morning. I've added to them, and I thought I saw the trade come to me when the market in D period high failed to trade by a single tick into the range. Okay, now you see what happens. Now, there's a little luck involved in this. You had some kind of news item, and you see the market make a very fast, strong run. Nothing wrong with a little luck, but the formation or the foundation increased the odds that if there was anything positive, it could make that happen. So now we have a poor high because we have no excess on the high. There's the market. Remember, we had a poor high from the previous session, matched by even poorer because it matched the high of 9.6. So the market's trading up there. What I'm ready to do right now is I'm getting myself in position that if this market goes up and trades back through the high from yesterday or the previous day, I'm going to let everything go. So you see it go up there, it's tagged. Hold on, if we can stop for just a second. Okay, so the high of the 12th right now just tagged the high of the 11th and the high of 9.6. When I see that, the odds are almost overwhelming that those highs will be taken out. Think about the traders in here. The mechanical nature of traders that blindly, automatically sell exactly at the high from the previous day. That's what traders do. All right, let's continue to watch this. The odds are very high that we're taking that high out. But the overall confidence for this day is very low. It's an inside trading day and it is rotational. Okay, we've tagged the high. Now, what my plan is here, if there's going to be stops above those highs. So they're protective stops. People, they're buy stops. A buy stop means they have to buy. That gooses the market to the upside. So what I want to do, as soon as I get a little pop on a short covering rally, I'm going to sell my calls. And there it was right there. As soon as E period broke above D period, I went market and sold 100% of my calls. Now, stop for a second if we can. One of the things that I hear from traders all the time, where do you get in? Where do you get out? Where do you put your stop? And I don't usually answer the question to their satisfaction. And the reason for that is they want exactness. Okay. I don't deal with exactness. I've constantly used the term exactness kills. And I got that from the point of view as a hiker, because I've done quite a bit outdoor hiking. And you don't wear things that will absorb and hold water when you're hiking, because it may get cold and you get hypothermia. You wear things that are what they call, they're wiki-like. In other words, they don't hold the moisture. And so there's always the thing that cotton kills. I say exactness kills. So in this point in time, now somebody's going to say, yeah, but Jim, what if the market went a lot higher? Well, guess what? If the market went a lot higher, I left a lot on the table, right? And that's, I said, well, I wasn't going to get out just then because I thought, well, the market may go higher and I didn't want to miss it. And I say, well, that's your choice. I look at the day and I say, it's a rotational trading day. The market didn't look to me like it had a lot of confidence, even though it came up very, very fast on the news announcement. I just said, I'm out. I'm not going to worry about anything else. If it goes higher, so what? Well, let's go ahead and start running this again. That's a mindset. Some traders, I'll tell you, they will freeze up there and they'll say, well, I don't know. Well, it might go higher. There's no room for that. You have to be firm in what you do. Sometimes you're going to be right. Sometimes you're going to be wrong. Okay, let's continue to play the market. So at this point in time, I have no trades on. I'm out of everything. And now I'm just going to watch the market and see what happens. It's been an absolutely magnificent day. A lot of luck involved, but those things do happen. At this point in time, I'm planning not to do any more trades for this session. I don't know what's going to happen, but it's been a really substantial morning. It's still a rotational situation in here. And I just said, well, I'll just step aside. Okay, let's open this up to a fuller speed so we can get through it. We don't have to watch everything in here right now. So let's go to, 30, 40 times. Okay, so it's going to move pretty quickly in here because we've speeded it up, but I want to show you how these days work. And there's one more thing that I want to show you before it's over. Remember early on, we said it's more than likely going to be a rotational trading session because it's inside the previous day's range. We said there may be a case when it looks a few ticks above or below on either end. That doesn't necessarily make a big difference. We have not taken out the low. We have taken out the high, but we've got a new high and low, and the market continues to rotate back and forth. Now think about this. Think about how many traders are getting caught up in here because they're in this inside day. There's nothing really going on, but yet they can't resist getting overly involved in trades in here. And they'll call me sometimes and say, what do you think it's going higher or lower from here? I said, I don't know. And they said, well, that can't be. You do this all the time. I said, I don't know. There's sometimes I just say, I'm not going to do anything in this market. So as you know, I covered my couple trades early, very, very fortunate trades. I'm out of the market. I'll let the market play out. I've been doing some other things. I'm keeping my eye on the market slightly, but I have nothing to do and I have no real interest in this day. But remember what we said early on. There are times when I let the market come to me. If you find yourself out there looking for a trade, more than likely, you are not going to be profitable. Now, we've said this in almost, every introductory tape we've made. You say, well, people say, well, Jim, I don't understand. Of course I'm looking for a trade. That's what I do. I'm here to trade. And I say, no, when you really get to understand the market, you just sit back and relax. And that doesn't mean you're not thinking, but you've absorbed a lot of information about the market. You just let the trade come to you. And if it doesn't come to you, you don't trade. But occasionally you will see a trade that just speaks to you. You know it's there. And does it promise it's going to work? No. But you look and say, wait a minute, this is a reasonable trade. So again, I have no intention after the early morning trades, I had no intention to do another trade on this day. Okay, so the market's playing out, and you see it's true what we said early on. It's rotational, back within the range of the previous day. Now you see it trying to, trade lower, and some traders don't understand what's going on. They get all excited. Oh boy, I can't miss this trade to the downside. I got to get on this trade to the downside. Well, and all of a sudden it's a rotational day. So you get short, the market turns around and goes back the other way. Then you panic and you cover your short. One of the most important things you have to do to be successful as a trader is be able to sit on your hands, be able to leave the market alone. Because when you get a situation like we're in right now, it's just going to be very choppy. Oh yeah, one day you'll get it right. You'll make a couple good trades. You'll give it all back 2 or 3 days later if you get involved in these kind of markets. So you see the rotational, we're still within the previous day's range other than a few ticks at the high, but we did clean up the poor high. The market is now just continuing to rotate. Think about, we're going at fast speed, but think about how easy it is to get chopped up in here and give back a lot of money or lose a lot of money that you didn't have to give back. These are the type of situations that you have to stay out of. It's very hard to do. I mean, you sit there and say, well, you start looking for a trade and say, oh, I found a trade. More than likely, if you're looking for a trade and you found one, the odds are that it's not the right trade and it's not going to work. The harder you look, the greater the odds that you're going to find the trade. Additionally, the greater odds it's not going to be a trade you want to be involved in. So keep in mind, I'm sitting here. I have absolutely no intention of doing another trade this day. I'm just staying in touch with the market because that's also something we talk about. Continually staying in touch with the market. If you continue to stay in touch with the market, you will be surprised how often a trade will come to you when you weren't even looking for it or weren't even expecting anything. Now, the market's got my attention a little bit. I'm watching it try to trade higher in here. Now, if we can stop here for a second. Jen, can you point out the point of control? The point of control is, how many ticks wide is it? It's 2, 4, 6, 8, 10. Is that 12? Did I count that right?
So far it's 11.
Okay, it's 11 ticks wide. Now, at this point in time, you don't know
11 TPOs wide.
11 TPOs wide. At this point in time, you probably don't know what is a wide or narrow TPO or point of control. But I think I'm going to say there's 13 or 14 periods in the S&P or the E-mini. Right now, we're 11 periods wide. So that point of control, the fatter a point of control becomes, the more difficult it's going to be for the market to get away from it. The reason that point of control, that's the fairest price at which business is being conducted. In fact, if you think about the TPO as the fairest price at which business is being conducted, rather than the point of control, it will help you immensely. Because now when you look at this, the point of control is down at the 28.8650 level. So that's the fairest price at which business is being conducted. Now traders are buying up here where what's the current last trade on this market? I can't see. I've got something in my way.
28.91.25.
Okay. All right. So at this point in time, the market is trading above the fairest price for the day. Now, every time we do a trade, there's no certainty that trade's going to work. Everything I do, I like to think in terms of odds. One of the difficulties is that as humans, we're not very good in thinking in terms of odds. But you hear people talk about if you're going to be a trader, you have to have an edge. And what does that mean? You have to have something that's special to you to get ahead of the other traders. Being able to think in terms of probabilities, I think is something we can all do. Now, people will say to me, well, Jim, give me the exact odds. And I believe in, they call the scientific method. If you can't give me the exact odds, then they're not valid. And I say, well, yeah, I'm not a mathematician, but if I drive on a drive payment or I drive on an icy pavement, I don't need to know the exact odds to know that my risk of having an accident on an icy pavement are a lot higher than they are on a drive pavement. No, I don't know the exact odds, but I certainly know that the risk is greater. So now, we talked earlier about letting the trade come to you. When I see the point of control down at 28.8650, and I see the market trading up, in the range where it's currently trading, I think that prices have become too high. I think they're overvalued. Remember, the point of control we also think about is the fairest price at which business is being conducted. So I said, okay, if I can sell above the fairest price at which business is being conducted, I got the odds in my favor. Now, just because the odds are in your favor doesn't mean you're going to win. You may be playing 5-card draw. If your first 2 down cards are aces back to back, the odds are you're going to win that hand. However, somebody may draw out on you, so you may not win this hand. But if you play aces back to back over a number of times, you're going to come out a winner. Again, that's called playing the odds. So at this point in time, I go short. Remember, if I'm short, that means I want the market to go lower. So I go short right up in here someplace with the idea that before the day is over, it is a rotational day, that the market will rotate back down towards the fairest price at which business is being conducted. So let's see if that trade works. Let's go ahead and play out the remainder of the session. Remember, I had no intention of doing another trade this day. Look at that trade go up, the short's on and you're watching it and now it's reversed a little bit. You notice how it went up first and it rotates a little bit. They'd never make it easy, I promise you. Getting later in the day, remember the very prominent point of controls where I have my eye. And also you'll see the white line just below the end period low. That's half back for the day. And that's also a very logical place for the market to go. It's a very, it's a very visual reference. Every trader knows where half back is. Now you see where the reference I've been using is down there, and we know where half back is. So, I'm not going to get too fussy. Someplace around half back or maybe just below half back, I will take this trade off. So I'm looking someplace down there. Okay, have we run the day out?
Yes.
Okay, so you see the market came down to just a tick above half back. So was it a wonderful trade? No. Was it a profitable trade? Yes. You saw the thinking and the reasoning behind it. Now, when we get all done with this, we have an inside rotational trading day. Yes, on one period of time, we traded slightly above it. I'm not going to argue with that. We opened the day thinking the odds were pretty good. It would be a rotational trading day. It was a rotational trading day. There were some opportunities. Remember, the opportunities were shorter. They weren't big opportunities. They were shorter. But on a rotational day, you're looking for more trades, shorter trades. A couple of times, I had some trades. I let the market come to me, or let the market set up for something that was in my favor, allowed me to trade with the odds. So now, as we prepare for the following day, I said, okay, I have a balanced day. I have a balanced day today, which is 9/12. So from balance, then I'm looking to see if there's any change in the market. Then we come outside of balance. All right, well, we've showed you another rotational trading day. We said the high percentage of days will be rotational, or at least some rotation associated with them, probably about 85% of the time. On those days, we said, there'll be more trades, but they'll be smaller. And they're going to be more emotional days. We said on a rotational trading day, you probably are better off not to trade early. Now, what does not trade early? That doesn't blindly mean don't trade early. It just means don't be anxious to trade too soon. Now, I traded fairly early this morning, but the market set up and gave me that opportunity. So I wasn't blindly in there trading. I got to trade. The market gave me an opportunity. When it gave me that opportunity, I took it. There'll be many more days in your career that you'll see, rotation. But hopefully, this is another example of a rotational trading day and how to use these days and how to see them.